Hey guys, yeah, very happy to have Michele Schneider back with us from MarketGauge. We'll have a bit of a higher time frame look at a number of different markets. Talk about this ongoing virus and some of the things that it has caused as far as demand. We're seeing obviously a little bit of a bounce back in the overall equity markets. So we'll jump right into things here and say good morning to Mish once again. Happy to have you back on the show, Mish. I hope you're keeping well during this crazy time that we're living through.
Yes, we're trying to follow all the rules of socially distancing. I've been going out to the supermarkets every week and shopping for other people, but so far, doing great.
It's obviously a crazy time, unprecedented. I mean, none of us have experienced anything like this before. I was at Costco on the weekend and had to wait out in the parking lot for about an hour before they let us into the store. So, but we're doing what we can, I guess, is the key. Let's jump into the markets here, Mish. Obviously, we're looking at this kind of rally over the past few sessions back into an area where we might consider it running out of steam once again. I noted this morning 20% off the lows now for the three U.S. major indexes. What are your thoughts on where we are at this point and where we might be heading?
Well, I think the market right now is really showing a behavioral reaction to hope, which is an emotion that is very strong in the market all the time. Hope, though, of course, immediately will turn to despair if there's any reason for hope to disappear. So right now we have hope. We have hope that the virus might be flattening. New York City, the mayor there came out today and said that the cases were definitely falling in terms of the exponential numbers they were seeing for a week. Worldwide, we haven't really seen much evidence of that. What I see happening with the virus is that it's shifting a little bit, and unfortunately, it is attacking a lot of the minority groups. I live in New Mexico, and the Navajo Nation is having a huge problem right here. But that's just an aside. Essentially, the hope also that the injection that the Fed has done, the high-yield corporate bonds are doing better today. And also, I don't know if this has anything to do with the little pop we just had, but Bernie Sanders just officially decided that he was not going to run for president. So we've really got a Biden-Trump race going on here. So that might have been a pop for the market too.
Yeah, which in itself obviously is going to make some headlines and move the market. As far as a headline-driven environment goes, how much are you paying attention to? And I mean, we're kind of speculating here. Obviously, this is something that's never happened before. But how much are you paying attention to those actual numbers when it comes to deciding what and where you're going to go with some of the positions that you're putting on?
Well, I always have a fundamental component to everything that I do. So, for example, in terms of the overall market, yes, we're headline sensitive, and that's why we have the volatility. Oil is still under pressure, and that was a huge factor last week with the hope of an OPEC meeting, and then all of a sudden that changed. So you saw an immediate spike on what looked like it was fake news that Saudi Arabia and Russia had come into a conversation. And then, of course, you saw the immediate dump. So that's where the headlines are really affecting. In terms of the general macro, though, I pay attention, obviously, to what's going on. I'm watching the COVID-19 numbers like everybody else. I'm watching for more stimulus packages to come into play. But then there's also, this incredible dichotomy of Wall Street, Main Street still going on. Here's a perfect example. In the last 24 hours, my sister and also a very close friend of mine both got furloughed. So they're now signing up for unemployment insurance. And the big question, of course, is going to be, when do these businesses get to open up? And that's kind of where I think the disconnect is right now, where the hope is everything's going to turn out great. And then the reality could look very different. The economy can really have an impact that's far worse than what people expect. Or in any case, if there's any damage to the economy that is longer lasting than what some of the people who are the talking heads are anticipating, we could see that hope again turn to despair. So that's where I pay attention. But basically I like price. I was born in the New York exchanges, commodities exchanges, where we didn't see news at all, really. We just watched price. And so as a result, to me, price rules everything.
Yeah, I want to get into some of the charts that you sent over to us, TLT, the debts, ETF, LQD, and also volatility coming up here in a second. But I did note, Mish, I want to get your thoughts on this. A lot of people have been kind of pointing to Italy and pointing to also China as far as their numbers go, and we're seeing them kind of slowing. But again today, Italy posting higher cases once again and higher death totals. So, we had a few days in a row that the numbers were kind of stabilizing, and then you see that uptick. As far as a reaction goes from the overall market, I mean it's hard to say, obviously, but how much are we paying attention to what has happened in Europe and what has happened in Asia when it comes to the numbers that we're seeing there?
Well, we should be paying attention. I mean, there's certainly speculation that China hasn't necessarily been all that honest with the numbers that are coming out. But then again, we are seeing a second surge in Hong Kong that has come out. And yet Wuhan has opened up their airports for people to exit the country. So, it's really hard to know, but you're right. I think we should be paying attention to Italy, to Spain, to France, because that is really where things went out of control first. When they peak, it could be, a week or two till we start peaking in numbers. One day information is not a pattern. It's just like looking at charts. So again, there's so much unknown that you have to really kind of pay attention to the reaction to the news and not necessarily to the news. And right now, whatever the news is, the reaction has been, whether it's going to be the Fed saves the day or things aren't as bad as it seems. I don't necessarily buy that, but nonetheless, this is a good time. You guys are doing day trading. That is really the way to go. If you want to really take longer term positions right now, then you will have to be subject to the obvious volatility and that anything can change overnight.
And it's obviously extremely difficult when you go out to a higher time frame to predict, obviously, where we are heading next. Let's jump into some of these charts. I want to talk a little bit about the TLTs, the LQD, and the VIX. What are you seeing in those?
Well, the VIX right now, I'm looking over at my radar screen, excuse me. So the VIX right now is inside the range of last week. And so that's very interesting to me. It was a huge week. I think the low was 39.50 and the high was like 60. And so what you see here is I have two charts. The one on the right is the weekly chart. So that's where you can see the inside week forming. And on the other side is the daily chart, which of course is still in a bullish phase and coming down into that support. So if we just think about volatility in and of itself, yes, it's come down from the peak high that we saw when we made the low in March, but on the same token, it hasn't exactly collapsed. So I think this is an indication right here. Now, if it breaks down under 39.50, we might see one more swoosh up in the overall market. On the other hand, I'm looking at around 45 as sort of a midpoint to watch. And yesterday, of course, these are yesterday's charts. Today it's trading, it's down, but it's still trading above 42 at this point. So that to me right now is showing that, yes, we're getting a pop on that hope thing, but volatility is not necessarily coming in at this point because it's still not necessarily known whether that's going to be sustainable.
And when it comes to both the TLT and corporate debt, obviously LQD, we've seen some absolutely crazy moves, especially in LQD. How are you approaching those?
Well, LQD has been a huge instrument to watch right now because it's high yield corporate debt. And that is really where the Fed came in and injected a tremendous amount of money so banks could buy it. So those are your bigger companies that's holding the debt of the bigger companies like GE, for example. And so really it's an unbelievable indication. Now the chart you just put up yesterday, again, as of the close, if you look at the bottom, that's the ratio of the LQD and the TLTs, which of course is just the 30-year treasury. You can see that in the longer term, of course, it really broke down where the treasuries were well outperforming the high yield debt. But then yesterday, you can see that it crossed over that lower line a little bit, and that's somewhat of a stabilization. So that's what you're seeing right now, and that's why the market isn't going down at this point.
One of your keys that we like to focus on every time we have you on, Mish, is your economic modern family that you like to talk about. Tell us what you're seeing in all of these charts. I mean, it's obviously a bit of a mess, coming back to the upside. But as you mentioned, we're kind of getting into an area where we might run into some trouble to the upside.
Well, right now, even in the stronger instruments, like in the Qs and in the SPY and in the semiconductors, we're really heading right into some resistance on the weekly charts. But they took off long before the modern family did. What's interesting that's happening today is that in terms of the weekly charts, which I'm looking at right now, semiconductors is back over the 50-week. Well, that's not a surprise considering that the tech has always been the strongest instrument for the last several years. Biotech is sort of hovering here, but also doing better. In fact, it's in a bullish phase on the weekly chart, the only one. And then if we look at the outliers like KRE, which is regional banks, which is very tied to oil, it's still struggling to get through the highs of the recent weeks. XRT retail is doing better today, which is interesting. I think it just got so beat up and so oversold. I did think some of the companies were looking very, very interesting because they were just so incredibly cheap. Like, for example, CPRI, which is Jimmy Choo and Michael Kors. I watched that very carefully. I did not think that those companies would go out of business. So when that stock traded down to around 8, it did seem pretty obvious that that was maybe a good buy. The question is for how much longer. That's really going to remain to be seen. So XRT doing pretty good today, coming back into the lower end of the range from a few weeks ago. And then finally, transportation. Amazon announced that they were not going to compete anymore with United Parcel Service and FedEx. And so what you're seeing right now is IYT getting a little pop off of that. But still, IWM, the Russells, into resistance at 118, IYT into resistance at 145, 33 in XRT, and KRE just has to get through 35. So right now, I would have to say that even with the rally in the SPY, it's just an inside day. The rally in the Qs, we haven't crossed any significant moving averages, and the modern family is reacting well. But right now, it's still telling me that this could just be a rally into resistance.
You had a nice big bright yellow circle around the IWM chart pointing to a little bit of negativity, I feel. Obviously, a lot of these look very similar in the sense that, we had the big move down, obviously, now kind of consolidating, putting in, some technical people might look at it as a bear flag. Do we, get back to the lows in some of these?
Well, what's interesting about that IWM chart is, first of all, one of the reasons why I put that ellipse around it was because people were talking about a V-bottom recovery. But, the reason the economic modern family exists is because, to me, that's really what you have to look at for a true economic recovery in terms of the inside of the U.S. market. IWM does not have a V-bottom. Now, in terms of a bear flag, it only is a bear flag if it actually breaks the pennant. And the pennant break is at much lower levels at this point. Depends on where you draw it. I drew it on the bodies of the candles. You can also connect it on the body of a wicks, which makes it a little bit higher. So if though, and this is why I had a 2-case scenario, it's either a bear flag or if it can close over 118 in IWM, then it looks more like a consolidation, and then we can probably take a look at some higher levels from there. So, that's how tentative this market is. It's almost on a day-to-day basis. And of course, Friday we're closed. So we have one more day tomorrow. And then it's really going to be a matter of how much risk people want to carry over a long weekend.
Let's shift over to the energy markets. Obviously, another group that has been just crushed over the past few weeks with oil prices coming to the downside. What are we seeing at this point? Obviously, we've had 2-3 days back to the upside now for the price for crude. Some of these individual stocks, though, not necessarily participating in that bounce.
Yes. Well, first of all, in terms of the actual future itself, I mean, it's hanging in there, but it's hardly wowing anybody. In fact, again, if you look at a weekly chart of the U.S. oil fund, USO, we're just inside the range of last week. Now, over 6, that would probably look a little bit more interesting. Then I think we can see, a nice big move up to around 8. But on the flip side right now, if this thing breaks down under, say, 475, All we've done really is had that couple of day pop on fake news, and then it starts to go back down. So like everything else, it's in this mixed bag, right smack dab in the middle, living on hope, but ready to turn on despair. And what could possibly make this more optimistic? I'm not really sure. But, you know, the market is future looking, and so maybe the market thinks that in 6 months this is all going to be resolved. I'm skeptical about that, but, you know, this is the whole idea of being a trader, is you have to be very neutral in terms of your own bias, and again, as I said earlier, follow price.
And another market that has obviously been hurt with the headlines. You know, we had the Saudi, Russia kind of price arguments that they were having, dragging down the energy market. But yeah, still looking on the weak side overall. Let's. I want to make sure we get through a number of these charts here. Let's move on to the dollar and gold and the relation between the two, and also silver. Tell us about those.
Well, you know, we've been long gold and silver now for a while. We've already taken some profits and looking to add. I'm sorry, I'm just got wires here. Okay, so anyway, I'm very long-term bullish in the gold and the silver. What's going to be interesting to me, and we've talked about before, is the idea of everybody looking more for deflationary factors, and when that flips to more of a stagflation, possibly even a hyperinflationary environment. And that's where looking at the dollar and the relationship between gold and silver is extremely important. So right now you look at the agricultural prices and they look deflationary. And that makes sense. I mean, but on the other hand, we have several factors to watch in terms of how this can flip, besides the actual dollar, which has come off the highs. And DXY, I think if it breaks down under 98, that to me probably says that this big attraction to the dollar, where the Fed was actually allowing people to buy dollars and swap for actually not buying debt, that might go away. And then we can start to see what happens with the metals. But, you know, the metals right now, gold, you know, there's that big disparity between the physical gold and then the actual futures of gold. 1700 is a huge area there. We tested it the other day and it immediately came off. So that's number one. Number two is with silver to gold ratio. It came in a little bit, but it went down to about an 85-year historical low. In commodities trading, when the silver starts to bring that ratio in, I think we're a long way from seeing it outperform, but if it starts to actually at least perform better than gold, that would be a sign for sure. And of course, I think that's going to be related to the dollar. Now, in terms of inflation, in general, we have many reasons to believe that that could happen. We have a supply chain disruption, you know, obviously because of the virus. What's going to happen to the labor market when this all resolves? You know, the labor market will be less, that's for sure. We've had environmental problems. There's been drought throughout the world, as well as locusts, believe it or not, that are still around, that eat crops as fast as you can blink your eye. And then on top of that, we will have potentially what's already starting in some, especially the poorer countries, is a hoarding of food commodities. So how does this all relate? Going back, you have to watch the gold. I think the gold breaks through 1700. We're going to see 1900 in a flash. If the silver, which is now holding at about, in the SLV in particular, at very good levels, starts to move out back over 14, it's sort of been struggling around that 14 level, good sign for at least the silver market. And then you start to watch the relationship. And then you have to watch the bonds, of course, the dollar. But really, I know I sent you one other chart, and that was at the agriculturals, which I have been watching very carefully.
And it's an interesting area, and I wanted to ask you about the food manufacturers specifically. Is this a sector where you would put, you know, a trade on in an ETF, or is it in a sector that you look at an individual name? Because a lot of them have been, you know, showing signs of life over the past couple of days.
Well, both. I mean, we actually have a position already in soybeans, for example. It hasn't done anything yet, but it's far from our stop. We gave that a very generous stop purposely, because I want to be in it if it turns around and then add to it if it does. But, you know, wheat, same thing. Wheat has, and again, we like to trade the ETFs in these things only because, you know, I have members who aren't necessarily futures traders, and yet they can all trade ETFs. So I like to look at WEAT. If that breaks out over 571, good sign. Like to look at the corn, which has been weak, but if it can get back over 13, CORN, good sign. So that's why I like to look at the basket of that, which is the DBA, the agricultural DB fund. So that's going to be a big key right there.
Fantastic. Mish, I mean, we covered a lot, obviously, lots to look at and lots of opportunities, I feel, still to come in the next few days and weeks as we all continue to deal with this ongoing outbreak and, quarantine and social distancing and everything that is affecting us socially and also the markets in general. Great points as always. Why don't you give everyone your social media accounts so we can get a hold of you?
Yeah, I just want to wrap up because we did talk about a lot, but it's really very simple. Number one is at this point, we all know that in bear markets, which the market clearly is in, we get these vicious rallies. We're rallying right into resistance being the overhead moving averages. In 2008, it was very clear because it broke down right at the death cross or where the 50 crossed below the 200 in the SPY. Now that moving average area is a little bit overheaded around 290. So I think anywhere between 275 and 290 more than likely is a short opportunity. Do I think this market has bottomed and is going straight up? No. Number 2 point is yes, watch the movement into the high yield corporate debt because that at least will tell you what the Fed is doing. And of course, there's the old don't fight the Fed. And then finally, I do believe that the second half of 2020 into 2021, we're going to start to see commodities with a reflation trade, possibly even a stagflation trade. And so again, to me, the better opportunity, if you can ride through this volatility, is to be watching those commodities very carefully.
Fantastic information as always. Michele Schneider, tell everyone how we can follow you on Twitter.
Well, I'm at Market Minute, and I'm very active there. I do answer everybody's questions and make a big attempt to be kind to people who are nervous. In particular, I look at anger as really a form of fear, and there's certainly a legitimate reason for people to be afraid. So I try to approach you with tremendous compassion as a result. So if you have any questions, feel free to ask me. And of course, I'm also on Facebook, Mish's Market Minute, and LinkedIn under my name, Michele Schneider. My website is MarketGauge.com. And so there's lots of ways to reach me.
Fantastic information as always. Michele Schneider from MarketGauge, an absolute pleasure once again. Stay well in this trying time that we're all dealing with, and we'll speak to you again soon.
Brendan.
There you go, guys. Michele Schneider from MarketGauge, covering a whole vast array of topics, obviously. Great information from a higher time frame perspective. It's always good to kind of go out and get a higher time frame view of where we are, where we've come from and where we could possibly go to in the near future. As we said, though, I mean, with these headlines, it's going to be tough to call on anything. So shorter time frames, obviously, the easier ones to look at this point. Let's maybe bring in the guys here.